The very popular Invesco has dropped their own income ETF. Today we'll talk mostly about QQA, the Invesco Triple Income Advantage ETF, and also RSPA, which is the Invesco S&P 500 Equal Weight ETF. Now, RSPA is essentially the same strategy as QQA, but just on equally weighted S&P 500 index. Now, this is a great income ETF for those who want income in a low interest rate environment. If you already have enough money that you're comfortable living with and maybe just want a few extra bucks a month to help pay the bills, this ETF could be a choice. Like usual, they will be selling covered calls. Now, I just made a video on what covered calls are, so if you're not familiar with how they work, check out that video and then you will become familiar. Now, try to think of QQA as two different components. The first one is just growth. This is the same as just owning the NASDAQ 100. You're gonna get some capital appreciation, and you're probably familiar with this, right? Like you own great big companies like Apple, Microsoft, Nvidia, and over time, as those companies continue to innovate, sell products, goods, and services, they're gonna go up in share price, and you're gonna get some exposure here to that. The second part though, this is where it gets a little bit more confusing because people see ELNs, they're doing an option strategy with ELNs, and people get a little bit confused about these, but try not to overcomplicate it. The fund uses an ELN or an equity linked note to create income without having to actually sell the stock. It's similar to if you owned a house but only rented out a room in the house, right? That doesn't mean that you lose your house if you're renting the rooms in it. What QQA is doing here is we're not obviously using a real home, but we're using financial instruments like futures and options. Now, the main objective of this strategy is to generate regular income by writing call options against the index futures position. This income is typically used to match monthly payout goals for investors. So that's how we're gonna get those big, juicy dividend payments every single month. It's by using the equity linked notes. Now, by using ELNs, they can collect those payments up front in the form of premiums. Those payments or premiums are then passed on to the shareholders in the form of dividends. Now, some other advantages of using ELNs include the rollover/reinvestment. So when you use an ELN, when it reaches the end of its term, the money can then be reinvested into a similar setup to get even more money. The manager might change the strategy depending on what's happening in the market, like how volatile it is, or how the options are priced. Now, it's also a way to avoid some stock risk. ELNs help protect the stocks in a portfolio from being sold when the options are exercised. This is important because managers may want to keep stocks that are performing well with strong growth rather than having to sell them to keep up with income targets. Now, other strategies may force them to sell good stocks, but ELNs avoid that. And there's, of course, the big institutional advantage. Invesco is a huge company. ELNs are typically used by big companies with specialized teams that know how to manage these complicated strategies. Smaller funds or investment products, they don't have the same tools, the same resources, and that's why you see a lot of them end up losing value, called the dreaded word that we hate, NAV erosion, if they have to sell stocks to pay out income. In short, ELNs are a way for big institutions to make money without selling their best performing stocks. Don't overcomplicate it, guys. They have the resources to handle this complexity. Invesco is a well-established company with a team of professionals running the show. QQA is giving around a 10% dividend yield. Nothing in this life is ever guaranteed, especially dividends, but QQA has a solid trading strategy. It's a way to plant the flag on midfield. It's a way to go from growing up in a middle-class family to building generational wealth. I can see this as a place to park some money, get a decent yield, but of course there are risks involved too. One would be that you're relying on the fund manager to make good decisions. That's a downside of actively managed ETFs. Humans can and do make mistakes, and those can be with your money. There's also the big concentration risk here. QQQ is notorious for mostly being big tech companies. If tech has a collapse, double QA will take a bigger hit. That's just going to be the reality of it. And of course, we're getting solid cash flow every month, and that is great. But the way we're able to generate that is through options trading, which limits the upside. So if the market does very well in a short period of time, double QA will only get some of that upside. So this is why younger investors may not be best suited for these types of products. It's a balancing act of steady income versus a chance at huge growth. Now, you are the only person who can determine what is best for you. It's not me. It's not the high yield dividend warriors on the internet. It's not people on Discord or the Reddit forums. It is you. And then, of course, there's the fact that double QA just launched in July of this year. So it's done pretty well so far, right? It's up 4%. It's paying close to a 10% dividend yield. It has $140 million in assets under management so far, so it's kind of quickly growing as more and more people learn about this fund. Those dividends so far have been around the 41 cent to 46 cent range so far. I'd expect around a 10% yield plus or minus 2 when we annualize it. But guys, even though it's done pretty well so far, that doesn't mean it's always going to do well. We have yet to see how this is going to do in a market downturn, right? The clappening will happen. If you're wondering about the expense ratio, they actually have completely waived the expense ratio through the end of the year. This is a way to just get people interested in the fund, get people invested. And it's actually a pretty low management fee of just 29 basis points once it actually kicks into gear starting on January 1st of 2025. So pretty cool feature that Invesco is providing for us. Right now, it's basically a free ETF. You might almost say it's free money. Guys, the clappening will one day happen. You gotta take calculated risks. You gotta weigh the pros and cons. What are your financial goals? Ask those questions. If you're bullish on tech, then maybe this isn't the best option for you. For me personally, I'm relatively young, so I'll invest more into growth stocks, but I do like to dabble down and get some monthly dividends. It motivates me to work harder, and when I see that money coming in every month, it's great motivation for me to work even harder. I love that there's brand new ETFs coming out all the time. It's just one of many funds that we can hold in a diversified portfolio, and the lower and lower these expense ratios get, that's better and better for us, more money in our pockets. Make sure you guys are subscribed for income updates. Hit that like button. Check out the Patreon for my full $200,000 portfolio and all my weekly trades. My videos are found in podcast form under the Clacked Cash podcast name and all.
My goal for this portfolio is to generate income. That's all it does. And right now, currently, it just remember the pyramid scheme that not pyramid, the